I remember the point in my trading career where I would just sit and stare and watch the stock I just bought tank over 15% in one day. And the worst part is I had no idea why. The stock looked really good, the trade was looking really good on the lower time frames, everything was moving really well, and then out of nowhere it just reversed. I either got stopped out or even worse, I didn't put a stop loss and I lost everything. I sat there for an hour looking at the charts, wondering what went wrong. What did I miss on this chart that was actually telling me that the stock was going to reverse? And here's the embarrassing part. At that point, I was trading for over a year and I thought I knew everything about technical analysis and I thought I could read charts perfectly. But the truth was, I couldn't read anything. I was looking at charts every single day, but I actually had no idea what I was looking at. I was just gambling, I was hoping, and I was praying that the stock would move in my direction. And that's the problem with most traders starting out. They pull up a chart, they see some candles moving up and down, and they think that they know how to read that chart and they know how to actually have an edge based on what is happening. A chart is a story. Every single candlestick is telling you something about the market participants. If you don't know how to read the story and all you're reading is one chapter, you're never going to be able to have an edge in the market. Now, this is episode 2 of the swing trading series. If you haven't watched episode 1, make sure to go do that and tune into that first. In that episode, I broke down exactly how the market moves, the foundation, why there's no holy grail strategy, and how to make sure to have the best risk to reward on your trades. Now, in this episode, you're going to learn everything about price action. I'm going to teach you how to actually be able to read a chart and tell the whole story. Everything from reading specific patterns, support and resistance, and everything you need to know to be able to dissect the market structure. This is beginner-friendly stuff, but don't let it fool you. This is the whole backbone of my 7-figure trading strategy. And the reason why most people don't make money in trading is because they overcomplicate their trading system without learning the foundations the right way. After this video, you're never going to look at the chart the same way. Let's get straight into it. All right, so now we're going to get a deeper understanding of how to actually read charts and use them in our trading. A lot of people think that charts are like the end all be all of trading. It's not true. You actually want to use charts to have high probability and to make sure that you have a tight risk level that you can put on a big position and have a tight risk. Usually that's going to be at a specific candle's low. I like to use the daily candle, but a lot of people use other specific candles. And today we're going to cover all of that. So whenever we're looking at candles in the market, let's just understand what the actual candles look like and what do all these kind of factors in the candle mean. Because honestly, up until about a year and a half into my trading, I didn't honestly fully understand candlesticks, even though I thought I did because I was just looking at charts, but I didn't really understand them deeply and understand how they can benefit you, because the candlesticks just tell you in real time what price is doing. So you can tell a lot about the strength of a stock or a sector by the candles that the stock or the sector is printing. And you could tell a lot about the psychology of market participants knowing what's going on in the market. For example, when there is like a hammer candle, that means that there is a lot of sellers trapped to the lows, a lot of buyers stepping up off the lows. So it tells you demand is increasing, sellers are getting frustrated, and that could lead to a pretty nice squeeze. So using these patterns, using these kind of emotions of the market participants, you can have an edge in the market. So how do we actually look at candles? Well, of course, there's going to be green candles and there's going to be red candles. Now, the one thing that's important that not a lot of people understand is a red candle does not actually necessarily mean the stock was red on the day. What the red candle means was that the open was higher than the close, right? So the close was actually lower than the open. So a stock opened up here and it closed down here. It actually could be still green on the day. So a stock might be green, but the candle is red because the close is lower. So the close determines the actual color of a candle. It's the same thing with a green candle. So a stock might gap down, but if it opens lower and closes higher, it's going to be a green candle. Now that we understand that, we can see exactly where the open and close are, right? So on a red candle, the open is always going to be above the close. So it's going to be the one at the top. This is where the open is going to be. This basically means where the stock opened at exactly what price. That is what the open means. So the body of a candle just basically tells us the open and it tells us the close right here. Now, we also have high highs and we have lows. And these are different levels on a candlestick that tell you how high the stock got for the day and how low it got for the day. And we call these wicks, right? So this is a wick. These are the bodies right here. And then you have obviously the wicks at the highs as well. Now for a green candle, it's going to look almost the same. The only difference is the open is on the bottom. So the stock opened here and it closed up here. Now, the most important part of a candle is not the wicks. It's not even the body. It's the close. Where did the stock close? Did it close near the high or did it close all the way at the low? That tells you who was in control for that candle. So for example, if you're on the 5-minute chart, it tells you who is in control over the 5-minute candle, because who is able to close the stock at the highs of the candle, who was able to close the stock at the lows of the candle. Did buyers win the battle, or were sellers able to take price lower and close at the lows? This is one of the most important concepts of a candle, because whenever you're looking to take a play to the upside, you want the close to be strong. You want the stock to be closing near the highs. Too many people see a stock closing at the lows and they're still bullish because the candle is green, but the stock still closed at the lows. You want not a big upper wick whenever you're looking to play the upside on a stock, and you also don't want a big lower wick when you're playing the downside, right? So you want the close if you're looking to short or play the downside or you're bearish at the lows, as close as possible to the lows. If you can get close as possible to the lows on the sell side and as close as possible to the highs on the buy side, now you have a strong bullish or bearish candle depending on where the close is. Now the wick is also going to be pretty important. You want to see how a stock reacts when it hits specific levels. Sometimes what you'll see is a stock will hit a level of support, right? Which means that it has demand at the lows, and then it will create a long wick off the lows, right? And then sometimes if it's strong enough, it'll close at the highs. Sometimes if it's not strong enough like this, you could see it'll close somewhere near here. That tells you the strength of the candle. The close tells you exactly how strong the candle is. And if it can turn green off of that low, that's a super strong candle. But if it stays red, it's probably going to be a weaker candle and it's not seeing as much demand off of that low. And it's the same exact thing off the highs. All right, so now that we understand the simple way to actually read the candlesticks and what they mean, we could start to put together some sort of patterns on a chart. Now, the most important thing is understanding that there's different time frames for charts. So if you head over right here to your time frames on whatever charting platform you're on, you could see you have the 1 minute, 2 minute, all the way until the 45 minute, and then you have the hour all the way to 4 hour, and then you have the 1 day all the way to 12 months. And you can even get a little bit more specific on certain platforms and see specific time frames. Now, the most important thing is realizing that the bigger the time frame that you're looking at on a candlestick or a chart, the bigger the move that you're going to get, because you have participants on every single time frame on that bigger time frame, right? So if you're trading a daily time frame, there's participants on the 1 hour, there's participants on the 30 minute, there's participants on the 3, 5, 1 minute. But if you're trading the 1 minute, there's probably only traders that are looking at the 1 minute participating in that move that is happening right now, right? Because the other traders are looking at the bigger time frame. So understanding your time frames is super important. What I usually like to do is use the bigger time frames for my setups, because I always want to look for a biggest move as possible. And then I use the lower time frames to get what I like to call sniper entries, meaning I get really good entries off of key spots using the lower time frames. And that gives me an edge in the market because I'm able to put on size at a very high probability and a low risk level using the daily time frame, but not take as much risk as someone who's trading the daily time frame for their entries, because I'm using the lower time frames for my entries. All right, so now that you understand that there's different time frames, you can see the charts will look much different. So on the 5-minute time frame, the chart looks like this on the stock, and you can see we're clearly seeing a lot more that's happening during the day, but it's also much more noise. Notice how on the 5-minute time frame there's so much going on, but the stock barely even moved. But on the daily time frame, we could see exactly what is happening on this stock. So it was clearly going down here for a little bit. Now it's trying to change its trend and kind of try to push higher out of this spot. You can see a lot more and get a lot more analysis off the bigger time frame. So always remember that we like to start on the bigger time frames, the 1 week, the daily, even sometimes the 1 month, if you want a lot of a bigger time frame analysis. All right, so now let's look at some real examples on a chart of candlesticks and how they reacted to whatever the stock was doing and what price did. So for example, what I mean by that is you could see we have these two candles right here, and now we can kind of break down exactly what happened on these candles. So we know there's a green candle right here. So what ended up happening was the stock opened at this level right here. It got as low as this wick and it closed all the way up here, but it got as high as this wick right here, right? So that's exactly what a green candle will look like. Now, this red candle tells us that we had a move all the way up here, but we actually opened right here, right? So we opened right here near the highs. We moved all the way up here. We weren't able to stay above, and it actually closed all the way down here. Now, this is an incredibly bearish candle. Bearish means that sellers are in control. The reason why is because it closed all the way at the lows, right? And that means that bears were in control over this whole candle's time frame. And then you could see as the chart progresses, you have another pretty bearish candle. Even though it's green, a lot of people will say, oh, this is a green candle, so it's bullish. Well, actually, look at what happened on the candle. You had a chart that moved all the way up to this high. It opened right here, but it closed basically where it opened, even though it moved all the way up to the highs. If this was actually a strong move, it should close somewhere near the highs, like this candle or like this candle right here. This is how you start breaking down where the closes of candles are and actually taking into account what the candlestick is doing to get an idea of how strong a stock is just by looking at the candlestick. I'm not even using anything else right now. I'm just looking candle by candle. And then you could see once you start getting these wicks at the lows, this kind of starts telling you, okay, now buyers are interested. But notice right here, we closed all the way at the low. Right here, we closed all the way pretty much at the low. Right here, we closed at the low. That tells you that buyers are not interested. When there's a long wick to the downside like this, and the candle closes a little bit higher, now you know that buyers are starting to participate a little bit more. Same thing with the candle like this. You see how there's a wick and then it closes all the way up. That's a very bullish candle because it tells you that buyers took control near the lows, but were able to also take control of that whole candle and then close this all the way at the highs. That is a bullish candle. This is a bearish candle right here because it has a long wick to the upside, but buyers weren't able to control that move up and they ended up getting pretty much the whole move sold off, and then the stock closed right here. All right, so now that we understand a little bit about the actual way that these candlesticks move, we can actually start noticing some patterns develop, and this is called a candlestick pattern. I'm going to start with the most basic because this is exactly what I just taught you guys. Whenever a candle opens at near the highs and then closes all the way at the lows like this is going to be something that you're going to see, which is called a shooting star candle, meaning that buyers were trying to take it higher, but it closed all the way at the lows and it leaves a very long wick over. The long wick is usually always telling you that a certain party is taking control. Whenever there's a long wick and then the stock closes at the lows like a shooting star candle, that tells you that sellers are in control. Whenever you have a long wick to the downside like this, buyers buy it up and then they close near the highs, that tells you that buyers are in control, and that's called a hammer candle. So remember that hammer candle is going to be bullish. This usually marks the bottom on a lot of stocks, and we're going to use this candle a lot to be able to find reversals and also to be able to tell when there's strength in a stock. And it's the same exact thing for the shooting star candle. When the shooting star candle shows up, we know that there's weakness in the market and we either need to potentially short or we need to get out of our long position because the stock might be reversing. All right, so real life example of a hammer candle. You could see this is on this ticker right here. It just was making a big move down, and you could see the moment that it printed this candle, we actually had a pretty nice reversal the other way. And this helps you tell when buyers really are stepping in. So here's our hammer. We have a long wick to the bottom and then it closes all the way at the highs. This is called a hammer candle. And you can see this ended up being a pretty nice reversal on the stock. Now here we have an example of the shooting star candle, right? So you could see how we have a long wick to the highs, but we closed near the lows. That's going to be a shooting star candle. Usually these would extend a little bit farther out, so it'd be a little bit more bearish, but this would still be a pretty good example of that shooting star candle right here. All right, so those are some of the most important candlestick patterns. There's obviously a lot more. You're going to have your bullish and bearish engulfing. We'll get into a little bit more of that during this series, but I want to make this a little bit more advanced. I don't want to make this a beginner series. There's so many different beginner series on YouTube. I want to show you how to actually get a deeper read of the market and have a really good understanding of what's going on in the charts. So I just have the chart up here, no indicators, and that's something we'll talk about in the next episode, how we add indicators into this. But you want to start to look for specific patterns in the market because this will kind of be what candlesticks kind of do, right? Because candlesticks show us the emotions and psychology of traders in real time, we could start seeing some certain patterns develop in a stock. So what do I mean by that? Well, you could see right here, we have a pattern that is kind of forming. This stock is not really able to get new highs, right? So it's not really able to get over this level, and it's not really able to get under this level. This is called a base or a pattern, right? This means that there is consolidation in the market and there's no real move happening. So for example, you could see right here, there was a pretty nice move on this stock, and then now it's kind of consolidating and not really making any new lows, not really making any new highs. So with knowing this, we can anticipate that there will be some sellers into this range, right? Because there were buyers into this low, so there's probably going to be sellers into this range. So there's a few different ways that this can go. Either this can reject right here and then go lower back into the range and start chopping again, or we can do something that's called a breakout. And this is going to be very important because this is a big part of my swing trading strategy, is breaking this base, because the moment you start breaking this base, either to the downside or the upside, that's when the real move happens. You don't want to be trading much in consolidation. Sure, you could be playing rejections and then you could buy the lows, right, for a small move, but you want to actually catch these type of moves in the market, not really these small little moves in the market, right? We want to be in these stocks that are able to make the biggest moves, and that's why it's so important to understand the actual structure of stocks. So now that we understand that there is a potential pattern happening here, we can actually start to add in a little bit more. So this is obviously going to be our support level. Support basically means you have a level that a stock is testing multiple times and holding. It means that there's demand, that the buyers are trying to hold this level, and this usually will show up based off of a swing low. So basically a low that was created within the range and a high that was created at the high is going to be your supply zone or your resistance zone. This means that there's some sellers up here and they're trying to defend this level. This is a super simple concept. It just basically means that, the market's going to try to defend these two levels. The moment that level breaks, you're probably going to get a pretty big move in the direction of the break. Now that we understand kind of the horizontal support and resistance lines, we can start adding trend lines, and this is going to be super important. A trend line basically tells you what the trend of a stock is. So for example, if I start at one of these lows, or if I start at one of these lows and I draw a trend line, I'm trying to connect as many lows as possible, like so. Drawing these is not really supposed to be hard. You can draw them like this. You can skip over the wicks. I like to draw them into the wicks like this, so it makes very common sense exactly where the levels are. And now you can see we have a pretty important level right here. So if price comes back down into this level, it might have to hold up and then push back off that level. We can do the same thing for resistance. So we can start at the high and then connect as many dots as possible. And you can see we have 1, 2, and now we're getting kind of a break above this level. This could start being our potential breakout as the stock starts to break a trend line. And this is how you start putting together some trend lines. This is how you start putting together some patterns. And you want to start doing this on all your charts and practicing so that you know exactly the key levels that you should be using on a stock. And you could draw trend lines any ways that you want. The most important part is you want to start at a swing low and then just kind of connect as many dots as possible. So you could see this trend line right here was holding up very well for a few kind of weeks, and then eventually obviously it broke. These don't always just hold. If it was that easy, everyone would just trade trend lines and make a ton of money. But the most important concept is understanding that these are not, your holy grail, but you could use them to figure out if a stock is compressing. To me, the only thing that matters is finding patterns within the market. I want to be able to find consolidation. I want to be able to find patterns, and then I want to play the continuation out of these patterns. You could see these stocks right here are setting up and then they break out. This is going to be your bull flag. There's so many different patterns in a stock. There's a bull flag pattern, there's a wedge pattern, there's an inverse head and shoulders. The only thing that's important, you don't want to get too caught up in these, is that there is consolidation. This is what all these patterns mean, right? So just like we talked about here, there is consolidation. Sometimes it's much smaller and it takes a few days. Sometimes it's much longer and it takes a few weeks, and then you have a massive setup that sets up. But you always want to be looking for these patterns within the market, because this is where you're going to be looking to put on your risk. The patterns give us a repeatable system that we could trade over time. All right, so now that we can start putting together the fact that there's patterns, the fact that there's trends, and the fact that there's candlestick patterns that happen in the market, we could start to find these kind of things together, right? So for example, if we zoom out on this stock right here, we can clearly tell by drawing a trend line that it's uptrending, right? We can either draw it like this or we could draw it like this. Now, most important thing to understand with trends is that trends happen based off of the stock's move, right? So if a stock makes a new high and then it pulls back and makes a higher low, now it's in an uptrend. So what that means is if we go and look at it like this, a stock will go up, it'll make a higher low, and then it will go up again and get back above the previous high. This is called a trend. So this is going to be your uptrend whenever you make that new high, right? A downtrend starts when a stock fails to hold the previous high like this, makes a lower high, and then a lower low. So now you can see this is a downtrend. And this kind of looks like an ABC type of move. The same thing with the upside. And sometimes this ABC move will happen for months. So you'll get an ABC move, and then you'll get another ABC move, and you'll get another ABC move, and then the stock will continue to go lower. The moment it starts making a higher low and then a new high, now it's potentially starting to uptrend and counter trend against that trend. And understanding that is very important, because if we go back to the chart, you could see that this stock has basically just been uptrending. It's going up, making a higher low, going up, making a higher low, going up, making a higher low, going up. And knowing that the stock is in an uptrend, that just tells us all we have to know. Instead of looking to short it, to play the downside, we want to play within the trend of a stock because that's a pattern. A pattern is looking for a trend in the market. So if we know that the trend is up, we wait for a setup. This is going to be your setup right here. You have a pattern that is forming. This is going to be kind of called your pennant pattern. And now you can see you even have a little bit of a hammer off of this low right here. You know that this stock is starting to get bought up. And now we're just waiting for the compression to resolve, meaning it either breaks to the upside, like we said, or breaks to the downside. And that could be a potential strategy of taking an entry on this stock. Now, it's not as simple as that, of course. This is just going to be just price action, but understanding that price action is the truth, and you could essentially just trade the price action and have a profitable strategy is the most important part, because too many people will put on thousands of indicators, will try 20 different strategies, but everything revolves around price. Most important thing is understanding price at its core and then adding some layers on top of it that give us a better guide to what is happening and give us key levels in the market that we can kind of use to take advantage of. So in the next episode, we're going to learn a little bit more about trends, the moving averages, how we can start piecing everything together after we kind of understand how price moves, and then putting all these things together and making a strategy that actually works and using that to obviously have an edge within the market. So if you guys enjoyed this episode, and I'll see you in episode 3. Let's get it.